Hi. Thank you all for coming. Obviously a bit of a sparser crowd for the regulation talk here, but we appreciate all of you.
We're going to make your time worthwhile, we promise.
Yeah.
You did not make a bad decision.
Yeah, it's a great time to spend the day with three lawyers. So we're going to start with some brief intros before we get into the topics here today, and we'll start with Karam Dara on the left.
Hey guys, my name is Karam Dara. I work at a company called AirSwap. AirSwap is a decentralized peer-to-peer trading network for Ethereum tokens. We're a little bit different than just about every secondary trading solution out there. Our protocol, the swap protocol, enables peer-to-peer transfers of ERC20 tokens with no custody taken by us, no order matching, and no trading fees. I handle all things legal and regulatory. I'm an attorney. And so my job at the company is, I guess, kind of the basic things you'd expect from an in-house counsel, with the kind of added twist of doing a lot of regulatory and policy work as well. AirSwap went live in April, and since then, most recently, we released our new product called Spaces, which allows folks to leverage the swap protocol and smart contract in their own space in a walled garden environment where they set the onboarding parameters, the trading parameters, and are able to take advantage of the protocol that way. And so I'm going to pass along to Joyce.
Hello, I'm Joyce Lai. I am an attorney. I'm on the legal team at ConsenSys. For those of you who may not know, ConsenSys is a venture production studio with a focus on the Ethereum blockchain, founded by Joseph Lubin, who was one of the co-founders of Ethereum itself. We have a few different businesses. We do incubation, we have a venture capital arm, we do enterprise consulting, and we also do education. So sitting in the legal team at ConsenSys is a pretty broad mandate. So we do things like helping the product think through regulations as they're building their product, also in-house legal things, and similar to panels here, there's also a lot of policy work to be done in the space. In particular, one of the initiatives we have is called the Brooklyn Project. You're probably wondering why is the panel's called that, but the Brooklyn Project is the ConsenSys initiative to promote responsible tokenization economies. Basically, it started around November of 2017 when there was a lot of pretty irresponsible players in the industry. It was when Jay Clayton said, all the ICOs that I see out there look like a security, and we thought, we really need to try to move the industry in a proper direction to, take a pause and to really decide for ourselves how we can separate our projects and our company away from the scammy projects out there. And so since then, we've tried to put out a lot of thought leadership in a very open source, collaborative way. One of the pieces that I think is most important is the thing about taxonomy. One challenge of the industry is how do we talk about these very, very nitty-gritty concepts clearly so that we don't end up with the wrong language in the rules and policies. And before ConsenSys, I was a hedge fund attorney at the law firm of Stewart & Kissel, where I spent a few years advising hedge funds and practice securities laws and advisor acts.
Thanks, Joyce. My name is Brian Farber. I'm the in-house attorney at two different ConsenSys subsidiaries. One's called Token Foundry, and one is called ConsenSys Digital Securities. Token Foundry is focused on conducting utility token sales. So as a lawyer, that's a fairly interesting space to be in, given that the regulatory scheme is murky at the moment. So you're dealing with a lot of interesting players with different interests. So that's been fun. And on the other side, ConsenSys Digital Securities is ConsenSys' broker-dealer wing. So we're actively working on tokenized securities launches as well. My background before coming to ConsenSys was I was a securities lawyer at Sullivan & Cromwell in New York. So I guess to kick it off with Karam, what are a couple of issues that you see in the space right now that you face on a day-to-day basis?
So from my perspective at AirSwap, given that we're in the kind of secondary market space of tokens, I think one of the pieces and aspects of what we do at AirSwap that we feel really excited about is using the tools we've built to promote, kind of piggybacking off what Joyce was pointing out, responsible trading environments. And so fundamentally, we think AirSwap operates, in terms of what we like to call the decentralized holy trinity of trade, in that we don't take custody, we don't match orders, and we don't charge trading fees. And each of those is really important for a number of reasons. If you look at most of the hacks in this space, overwhelmingly they are not of the actual assets themselves or the blockchains that those assets live on. The hacks occur in custodial platforms. A number of the exchanges, the centralized exchanges out there, in order to match orders, they have to take custody. That creates a huge honeypot. And if you think about it, it's actually more risky than traditional exchanges of other assets, because cryptocurrencies and tokens function very similar. They're very similar to bearer instruments in that if you lose them, there's really no avenue of recovery. So by commingling funds that are designed to be bearer instruments, you're actually introducing more risk than would otherwise be there. At least in the case of a securities exchange, while they make custody funds and there's some risk that they get hacked, even though most of them will have insurance, a lot of security infrastructure, the assets themselves are usually in some kind of digital book entry form, or if they're still on paper, they're just representations of the underlying asset. The asset is still there. Here, when a cryptocurrency exchange is hacked, there's no recourse whatsoever. The funds are gone. And we think that's very important. Order matching is another piece of the puzzle when you talk about a lot of the market manipulation, things like front running, a lot of concerns that regulators have about these exchanges, and whether consumers are actually protected when they go on them. And lastly, transaction fees. As a lawyer, somebody who, and I failed to mention previously, I was also a capital markets attorney at Oric, and prior to that at Cahill Gordon. From a policy perspective, anyone who's engaging in transactions where they get a commission or they have trading fees, they have a salesman stake. And in this space, when you look at what regulators are looking at from a policy perspective in secondary trading, things like wash trading, front running, whether the exchanges actually have their own desks that are trading on those exchanges, all of those are concerns that they have that we think our technology addresses. And so we're really focused long term, kind of if you get beyond the initial phases. Obviously, a lot of the interest in the space was from the speculation, the high frequency trading that was going on. And I think if you think carefully from a regulator's perspective, that's where I think a lot of the attention and the focus is going to be for the next several years. And so long term, we think decentralized wallet-to-wallet non-custodial trading is closer to the ethos of the space, and is also safer for consumers from a public policy perspective.
Joyce, anything from you?
So one of the aspects of my job right now that is, have been challenging, and is very related to your point, Karam, is really explaining or even get people to start considering the possibility that there's this new thing called a blockchain, and there's these things called tokens. They're different, but yet not only should regulators think about how to regulate this stuff, but that they can actually use the technology to achieve the goals that they're trying to achieve, right? Most of the time people just want to have investor protection and to have consumer protection. We want the same thing because as our belief that if you don't have that, you're just not going to last very long. So, all the things that you explained, they're actually pretty complicated concepts, I think, especially for people who don't, have a lot of time to necessarily go through Reddit and read all the articles about it. It's really tough to keep up when you don't work every single day in the space. I have a hard time keeping up. So one of the things that I'm trying to do, as I'm speaking on these types of events, when we go out to talk to regulators, is to try to suggest to people that you can actually use the technology to solve their own problems, and to not be afraid of it, to not just think everything is a huge scam out there, that there are legitimate projects in this space, such as AirSwap, to basically help them, and they just need to learn that these exist.
Yeah, so in the utility token space, a consistent conflict that we run into is how to help projects raise money in a way that doesn't implicate the securities laws. You really want, as a project, you want to raise capital in a way that you're getting investors, but you're not. You're also giving them to people who actually want to use the network. Director Hinman from the SEC gave a speech a few months ago. There were a number of interpretations from that, but the primary interpretation, I think, is that people who are actually buying these tokens should intend to use these utility tokens for their intended purpose. They shouldn't be using them for speculative purposes. So what that means is, if the SEC were to look at your utility token sale, they'll look at it and they'll say, well, did you sell tokens using a SAFT, for example, which is a simple agreement for future tokens, to people and give them significant discounts. A lot of discounts in the market now, which seems to implicate that people are purchasing tokens for speculative purposes rather than use. There's a real sort of conflict there where a lot of projects in the past have issued significant discounts, have sold to venture funds who don't intend to use the tokens. And that's an issue in the space, and it's an even greater issue now because the market is, for the most part, pretty dead at the moment. So you're seeing a lot of struggle to raise capital, and if there is more focus on actual use, that's going to be problematic for capital raising as well. So there's a struggle now in the community, in the legal community in this space, to figure out creative ways to help companies, early stage companies, raise capital, seed capital, in a way that can be tied to the token sale, because traditional venture funding here, like a convertible note, might not work if that convertible note investor doesn't get some sort of token right, because you could see a token right as a liquidity event that would frustrate their rights as a convertible note holder in the future. But at the same time, it's very difficult to put a token right into a convertible note instrument, because there's an interpretation, I'm sure, that the SEC or others could look at that convertible note and say, well, that's an investment decision. You're choosing to invest in tokens if there's some sort of mandatory conversion right, and therefore your tokens are securities, and that could color your overall token system as a securities offering, and it creates all these various issues. So it's very complex, and there are a lot of other people in the industry right now trying to figure out ways to create interesting venture capital raise that are opportunities that are tied to tokens, but that's super important right now, and especially in a bear market, I think it's a good time for people to figure that out. So another thing that obviously is very hot right now, there's a track next door on securities tokens. There are obviously the securities laws apply to securities tokens, so that's a little bit clearer than the utility side, but there are an abundance of issues on that side as well. So I was hoping that we might be able to just run down the line and talk about what we've all seen in that space from a legal and regulatory perspective from our own vantage points.
Yeah, I guess I can start if you like. I think there's some sort of a global race going on in all the different jurisdictions to try to be the first to figure out how to structure a utility token. The difficulty in that is, part of it is a technical issue, right? What features do you actually need to build into this token, and what should be the proper technical standard? For example, like before, so before we had the ERC-20 standard, like ICOs weren't really a thing, but once everyone decided that is something that everyone can use, all of a sudden, like, ICOs became very prevalent, right? So we're still looking for something that is some sort of a technical standard for the security token space. And what people are thinking about there are things like, how do you insert a transfer restriction on there meaningfully? Like, how do you vet and reject certain people who may not have passed certain background checks, right? So those are some of the technical issues. But outside of that, I think custody is still a problem. KYC, AML is still an issue. It's been an issue for a long time, and it's still, in my opinion, one of the biggest things that's preventing, people like to talk about institutional money going into the space. So without resolving those points, we don't really have a proper ecosystem to allow for security tokens to be actually traded in a token form.
Yeah, and I'd agree with that. I think the most important thing is developing a consistent standard that goes across platforms. Because if the ultimate goal of tokenized securities is to achieve maximum liquidity, then you need compatibility across platforms and different avenues. You cannot do that unless you have a consistent standard. Building a consistent standard is incredibly complex because securities are, by their nature, incredibly complex. Transfer restrictions, for example, within the United States, if you're doing a private placement, you have certain Reg D transfer restrictions or holding periods. If you're transferring abroad, there might be certain transfer restrictions. In those jurisdictions, it's very complicated to be able to code all of those into a smart contract. We're just not there yet. How do you code dividend payments? How do you code voting? All those sorts of things, right? The goal is to eventually come to a point where all of the legal complexities of a security are actually functionally built into a securities token. And then you can take it a step further when you think about something like a debt security, like a note or a bond, which has an underlying legal agreement, like an indenture, which can be incredibly complex, like high-yield bonds are incredibly complex, different triggers within their contract that trigger certain rights in the security. Eventually, hopefully, you'll be at a position where not only is the fully functional security token online on the chain, but you have the underlying contract on chain as well, communicating directly with that token so that if something happens, some sort of event that happens that triggers a redemption, for example, that happens seamlessly. I tend to think that's a long ways away, but that's the ultimate nirvana that we want to reach in this space.
Yeah, I think I agree with everything both of you said. I think securities, tokens, or tokenized securities or digital securities, whatever the term is, changes every few weeks. It's interesting because when I first got into the space as an attorney, it seems like when I was practicing at Oric, all blockchain startups wanted to talk to me about was how to do a token that wasn't a security. And now that I work at a blockchain-based startup, I feel like I spend so much of my time thinking about tokenized securities. And I think just fundamentally, it's important to just separate out the two concepts. It's totally different. It's almost in some ways like not even close to the same as a utility token or a protocol coin. You're not using cryptocurrency as an incentive to secure a public blockchain, for example. What you're doing is you're using a smart contract or a token contract, and you're using that simply as a representation for something else. So what I was talking about earlier with cryptocurrencies being bearer instruments, that's not true when you're talking about digital securities. If you lost a paper certificate or you lost a security, there's still an asset there. It's not gone forever. And so it's much different. And I also think when people think about where the demand in this space comes from, call me crazy, but I don't think a lot of the interest and appetite for utility tokens was just because of the way they were technologically designed. It was a little bit, I think, driven by the opportunity for asymmetric returns, that folks could jump on tokens and they could 5x, 10x, 15x. That is not the case when you have a token that represents a real asset. If that's happening, something terrible is going on. And so I think understanding those differences is really critical, because if you don't understand those differences, I think you could veer off into some very odd directions. And one of the fascinating things that I've seen in the space in the emerging security token industry is in terms of secondary trading. The overwhelming majority of security tokens that have been issued are private securities. They're not registered securities. They're not publicly traded assets. They're offered using exemptions from registration. If tokenizing a security is just creating a digital version of that security, then the questions about how a security must trade or how a security token must trade, those are questions that are not answered by technology. Those are questions that are answered by securities laws. And so if private securities currently do not trade on order book exchanges, and they don't trade with the kind of frequency that publicly traded assets do, why would we expect digital versions to trade on platforms that look like stock exchanges? Those are private securities. They're going to trade probably over the counter. Now the question then is, how do we use this technology to make that process more efficient? So I think that's just one example of how I think some fundamental misunderstandings about what we're doing with this technology with securities can lead folks, I think, kind of astray. And it's definitely a building and a learning curve for everybody. But I think there was a little bit of a rush to jump into the security token space because people saw it as a way to take something that might be a violation of security laws and make it compliant, attract institutional money. But there are a lot of questions that need to be answered.
So Karam, just to piggyback on that, so one of the mantras of security token advocates is that it's going to greatly increase liquidity in the secondary markets, particularly for private securities. Do you see that as a possibility? How do you see that shaking out? Do you think that's overstated?
So I agree that it will increase liquidity, but I think we have to be realistic about what that means. So if you're talking about private securities for which there is pretty much no liquidity, and you have a process of getting in and out of a fund, for example, that takes months because you have to identify a suitable counterparty, check with a broker or lawyers to make sure that a transfer won't violate any of the contractual terms or any regulatory constraints, any transfer restrictions on that security. Then you have to repaper the transaction, then you have to actually do the trade, the settlement. Liquidity in this market might mean taking that process that takes weeks and months and condensing it down to a few days, with the actual execution, clearing, and settlement happening simultaneously in a matter of minutes. So I do think there's the opportunity for increased liquidity. I think when people hear that, I think they might think that there's going to be the kind of liquidity you would expect in publicly traded markets, and I don't think that's the case. Publicly traded assets are already pretty liquid, and they're already basically digital. When you buy and sell shares of stock, there's not paper being traded. It's either your broker's internal database, or if your broker is plugged in with DTC, it's seeding company that's actually the legal owner of all the securities. No paper is changing hands. It's just updates in an internal database. So again, I think liquidity potentially increased, but what that means in a private securities market, I think, is much different than what people might expect.
Yeah, no, that's definitely fair. So switching speeds for a sec, maybe we could talk a bit more about the Brooklyn project and what you've done there, and your recent trip to DC to speak with Congress, along with other people who've been involved in the space.
Yeah, so a few weeks ago, a congressman from Ohio, Congressman Warren Davidson, he hosted a cryptocurrency legislative certainty roundtable. That was a mouthful in DC. There was probably about 50 or so industry participants, really broad range of people. You had, people who are entrepreneurs like ConsenSys. You had like the Anderson Horowitz out there, DTCC, Fidelity, forget who else was there, but a lot of different people basically going into the room to explain to 4 or 5 lawmakers about what they're seeing in the space and what they're viewing as the most important things to get right in the industry. And I think the overwhelming message was, hey guys, like we really need to figure out what these laws are, more specifically what is a security and what isn't a security, because when we don't have this type of clarity, we don't know what to do. And if you're actually a responsible company, the best thing for you to do is actually to do nothing, right? And if that goes on for long enough, then companies will have to look for other places to do their business, and they might just leave the United States. And these congressmen really were very keen on listening to them. Like Congressman Davidson took a lot of notes. He was like really, really listening. So I thought that was really, really encouraging. And after the event, a group of them actually wrote a letter to the SEC to say, here's what we're hearing from the industry. We think it's really important for you to push this up your docket and to really do something about this. So I think there's a lot of well-intentioned and really smart lawmakers who appreciate the technology, are enthusiastic about it, and want to get it right and want to get it right fast. But there are also a lot of other lawmakers who just may not understand this as much, who are still, I think, too focused on things like, well, what about all the money laundering that is happening using Bitcoin? Well, there's money laundering and bad stuff happening using the US dollar too, but I guess it's less catchy to talk about. Like, we just need to be able to explain more clearly that, sure, there are maybe some problems and we can, build products and do things to solve them, but we shouldn't dwell on that and miss out on the more important things. Like, people are actually building the next generation of the internet here. Like, we can't miss that opportunity because we're too afraid of any particular thing.
Are there any initiatives right now, Brooklyn Project or otherwise, to actually reach those other legislators who may be more reticent to get involved and explain to them what this is all about so that they come to the table in a meaningful way?
Yeah, so that's one of the things I'm trying to do right now. I think we just need to put out more content and explain our message better, and to really show ourselves as a resource to the legislators. So whenever they have a question, like if they don't have, or if they have a question about how the technology works, like, we want them to think of the Brooklyn Project first. The Brooklyn Project is not like a traditional SRO. We don't want to be thought about that way. When you have an SRO, basically what you end up having is a few really large players who can afford a certain fee, and they get together and kind of set the rules for what they think the industry should follow. We want the Brooklyn Project to be a lot more democratic, like a lot more open source. What we do is we put out thought pieces, but before we publish like the final form of it, we have a Telegram group. We circulate it to every single person in the group, on Twitter and whatnot. We probably have close to 1,300-ish people in the channel now, and everyone gets to comment on it, and people do. So we put it on like Google Docs. We set in comment mode, and like people write comments. They suggest things that should be incorporated, and we take these comments, kind of write them in nicely, and filter out some of them to make sure like it fits in. And then like that's the piece that we promote. So we try to do this in a very democratic and open source manner, because not every single startup company has a chance to participate in like an SRO type thing, and maybe there's a place for them too, but this is like a very open source technology, so we think that the regulation and the policy work for that should also reflect that same philosophy.
Yeah, and I would, if I could just add, I agree with everything Joyce said, and one of the reasons at AirSwap we support the Brooklyn Project, and we are also a ConsenSys-backed company, is because I think in terms of this space, folks are always asking what the regulators are going to do, but very rarely are asking what the space is going to do and how the space should change. And so I enjoy the fact that the Brooklyn Project is proactive in trying to set standards and educate, because ultimately, we're the players in the space, and I think there are things that we can do. For example, disintermediating capital raising from tokens that are supposed to work as decentralized software. Being thoughtful about, the difference between custodial platforms and non-custodial platforms. In the space, there's a lot of what I call regulatory shilling. So everybody knows when, you're trying to shill for your token because you hold it and you want to, get folks to buy it. One of the things that I find really frustrating is you'll sometimes see companies that are doing something a certain way, and then they're incentivized to tell the rest of the space that if you're not doing it this way, it's wrong or you can't do it. It turns out, this technology touches a lot of different areas. Being an expert in one area of law is insufficient to have a global understanding of the ways in which this technology is implicated. In fact, you might tend to overestimate your particular area of expertise if that's the case, and that sometimes happens at the expense of other things. So I think, being proactive, but also being responsible and honest with folks about what's really going on, particularly around how trading occurs, how custody is handled, I think it's very important.
So just what do you guys think about, it's just part and parcel with what we were just discussing, but an increased focus on crypto lobbying groups. We've seen a lot of that come about. I think the Winklevoss brothers are trying to create an SRO in the industry. Do you think those initiatives are helpful in addition to initiatives like the Brooklyn Project, or do you think that having too many different lobbying groups out there at the same time with different interests in line could be detrimental to what the industry is trying to achieve right now with regards to regulation?
I tend to think the more the merrier, particularly in this area where a lot of the rulemaking and interpretation is done at the agency level, and executive agencies are not directly accountable. They are under the executive branch. Congress doesn't seem to do a whole lot, but they could do something. And so it's encouraging to see, and I think the more folks that are out there trying to push forward, the better. With the caveat of what I just said earlier, obviously folks are self-interested, and they're going to lobby for their positions. I think if you do that in a way that's honest and responsible, and remains to be seen whether that'll actually be the case, it's one thing. So that's why I think it really needs to be a combination. The Brooklyn Project being kind of an independent, separate group. It's not like there's a company attached to that. Whereas you see companies lobbying, it might be a different calculus there.
Yeah, just one more. I would say also that I think it's important for everybody in the industry to understand that creating meaningful, impactful, and useful regulation and legislation is incredibly tough and time intensive. So a lot of people have said, well, why is the SEC taking so long to put out meaningful guidance other than informal speeches, or why isn't Congress release something? Or it takes time. I think they understand the gravity of the situation and getting it right. We've all, I think, spoken to different regulators in different areas, and the universal belief amongst them is that they're interested, they want to do this the right way. The SEC keeps telling people, if you want to do a sale, reach out to us. We'll run you through the process. We'll talk it through. They just opened a resources center online as well. Jay Clayton, used to be a partner at the firm I worked at, is an incredibly business and market savvy guy. I mean, you go to him and he could tell you how the clearance process works. I'm not sure that an SEC regulator before him could ever do that. So the tools are there. It will take some time. I think they all realize that the longer they take, the farther the United States falls behind its competition in the world in this space. But there's an impetus to do it, and I think it hopefully will happen sooner rather than later.
So just to add on to your SRO point earlier, I think SROs make sense if they are defined well enough and they don't have some unlimited scope, right? To have an SRO for the blockchain industry seems like a really odd thing, because the blockchain is just this technology that can be used for literally anything you like. So to have an SRO for the blockchain, or to have an SRO even just for digital assets, is this really weird and odd and overly broad idea. It doesn't make sense, right? Even if you're thinking about financial instruments, is very different when you're a broker dealer for, say, stocks. Is a different thing if you're a OTC liquidity provider for certain commodities. So those groups of people have their own sets of issues, and if these more specifically defined groups of people want to set up their own SROs, I think that's fine, and I think that makes sense because there's actually a common set of issues that all of them are truly all dealing with. I think the worry that I have is that some people are trying to set up SROs in a way that they're trying to plant a flag in this new territory, and they want to be the approver of all things digital assets or all things blockchain related. And I think some of it is driven by the need from investors and projects. The people who want to do their stuff right want some sort of an indication or a certification to show that they did something right. That the industry is lacking that right now, and SROs try to be kind of that space filler in this vacuum. So I just don't want there to be some sort of a weird land grab and there to be a SRO or many SROs that just isn't, that is so broad that they actually don't have the substantive knowledge or ability to actually craft, their mission statement properly.
That makes sense. Do you want to open it up to questions, or is there anything else that you guys wanted to raise?
I have a question.
Okay.
For, I guess, just we were talking about this earlier. I guess if there are certain things you could change about the regulatory environment, or kind of looking ahead, certain what's like your wish list in terms of what you would see or what changes?
Yeah, I mean, I'm pretty simple. I just want like one no action letter or something like that. Just plant your flag, because I alluded to this earlier. Bill Hinman, who's at the SEC's Division of Corp Fin, gave a speech in June that talked about Ether and whether or not Ether was a security, and he mentioned that it wasn't now because it's sufficiently decentralized, whatever that means, and that he talked about various other items related to the Howey test and whether or not this was a security. And the response in the industry was that this was gospel and this was law, and it was just somebody giving a speech, and he made some really good points. But people went out there and were like, oh, well, now we're just, we can do a utility token offering because we're sufficiently decentralized that you can't get an opinion from a law firm on that. So I don't feel comfortable with that. I would love to see one tangible step, whether that's in the utility token space, or if that's for a custody solution or an ATS or anything, just one tangible step. And I think we're very close, because I know the SEC specifically has been communicating with various parties about various topics. So I think we're close, but that's what I'd love to see soon.
I think what I like to see, and this is extremely hard, so maybe this is just very wishful thinking, is for all the different regulators all around the world to just talk to each other. Because if we're trying to create something that is a globally liquid asset class, like, we just need standards to be at least somewhat working across different jurisdictions. There's like a race for the jurisdictions to be the first ones, and that's fine. But this is like really, really different, and without having the minds meet in sort of the technical level, or even fundamentally like what this is, like you're never gonna have that type of global liquidity that we're trying to get, right? So if I had one magic wand to wave to make it happen, it would really be for all of these different, regulators and jurisdictions to just have an open dialogue somehow with each other about this. I think it will be a real shame if you end up having really siloed environments with something as powerful as blockchain.
Yeah, I would agree with that. I have two things from like a regulatory perspective, and then one thing that I think the space just needs to change. I think on the regulatory aspect, I would love, similar to what Brian was saying on the primary side, I would love some kind of avenue or guidance to make it possible to sell a token that's not a security, a token that's designed to be a part of a decentralized network to power decentralized software. I think that's important. I think there's a lot of other great use cases of blockchain. I think tokenized securities are great, but in a lot of ways that's using technology to make something that we already do a little bit more efficient, whereas capturing things like network value and shared computing power, those are things that we have not been able to do before until the advent of this technology. And I think it's important to facilitate growth of that aspect of the space. We're falling behind, I think, globally in that particular area. On the secondary trading side, I think centralized custodial trading platforms have a real value to the space in terms of making it easier for users to get acquainted with this technology, making it easier to trade, but they need to be, I think, treated differently, given that they're holding and they're commingling funds. A lot of the consternation, I think, that regulators have is the risk of hacks of all these exchanges, a lot of the market manipulation going on these exchanges, and a lot of the speculation, which is not, if you think about the way blockchain assets are designed, they're actually designed to be, designed not to be traded with high frequency. It takes a minute or two for a transaction to be recorded on the blockchain. It's not designed for very quick trading. And so I think some distinction on that front would be important and useful, and provide some consumer protection. And then lastly, in terms of the space, I think if you get some of those changes on the regulatory side, it would be nice to see projects separate capital raising from token economics and how a token should function. ICOs, and we talked about the terminology piece of it earlier. The terminology in this space sometimes doesn't make any sense. ICO is being used to raise capital if it's supposed to be analogous to an IPO. IPOs are traditionally exits. That's not the initial capital raise. And so it would be nice to see projects that are financed and funded the traditional way, that develop software, a protocol, develop some kind of network, and then sell a token, not to raise money, but as the product. If it truly is software or license right, I think that would also, it would comfort regulators, and it's actually a path forward. I think if you try to separate out the capital raising stuff from the token issuance and the token economics, the way it works with the network.
So if anybody has any questions, I think we can open up the floor if we have time.
Yeah, it's really, really hard. I feel like one of the aspects of my current job that I never really thought I would have signed up for is actually a little bit of diplomacy. Like, we go around, we travel, and we talk to lots of people in a lot of different ways. Depending on who you talk to, I find myself like trying to not offend people. So, if I'm talking to someone in the United States, I'm trying to help them understand that, you can be the first one. Like, it's not too late for you to, like, get your act together. But I'm actually saying the same message everywhere that I go, right? And there's this, like, inherent desire to try to pass, like, that first law that's going to make this technology super usable and friendly, like, in my particular jurisdiction. But I think the piece that people are forgetting is, like, we're actually still trying to figure out how the technology works for this stuff. So I think if we can convince these different policymakers to think about the technology piece first, like to spend more time and resources to think about that, as opposed to trying to think about what tax laws to pass or like how to rewrite their securities laws. Like, if they just realize like that should come maybe at the same time, but possibly a little bit later, I think that's helpful in like moving the conversation forward. Like, the way I think about it for myself is there's like this floodgate that's about to be open, and there's a key to it, but that key actually is like many different keys from all the different people, and that's the technology piece, right? Like, but once like that floodgate is open, you want to be that person to have the bucket ready to catch like all the flow that's going to come from that. But first, like, we all need to figure out how to open the floodgate first, because if that doesn't happen, everything is kind of useless. So I think one message or one perspective is to explain to people they need to focus on the technology and not as much on how to beat the next guy in, passing the right tax laws, because we're just not really actually there yet.
There's another question.
I actually had a very similar question to this gentleman. In fact, a lot of the corporations in the States, and as an attorney practicing outside of the United States,
Yeah, so we're definitely global. I think the problem in messaging, maybe we need to think about this more, is the name Brooklyn Project. We've had some feedback from people where it's not clear like where in the space we actually care about, and the answer is we care about everywhere, right? Like ConsenSys actually has offices, I think, in over 30 different jurisdictions now. So we're definitely not just focused in Brooklyn, that's for sure. Um, yeah, but it's also really hard because even if a place has the same law, like the way these laws are enforced in the different like court systems or just like legislative systems and the enforcement mechanisms can actually change the outcome a lot. So it's a really, really hard question, but a really important one that you raise. And part of, our thinking is that we just need like a platform that's really, really open that everyone can comment on it. Like if a regulator wanted to go comment on our Google Docs, they can do that. There's nothing stopping them, right? Like they can maybe do it on their weekends or something. But like so I think having this open source way for people to provide their input on these types of policy issues is the best thing that we can think of, at least, to get people's conversation going. Um, yeah, I hope that answers your question.
Cool.
So, kind of pretty much on the same topic, but another variation. What do you guys think about the concepts of competition versus cooperation between nations and, in the context of global regulatory environment? If I think of, I guess it's nice for both nations to cooperate so that they have the same laws, but what if they just all cooperate and collusion instead of cooperation so that they have laws that are not that great, that are kind of progressive, but that are, bad for the that they might be, I wouldn't put it past them to do that. So I was wondering what you guys think about cooperation and, if you're going to make bad laws, then, pass those to other countries and work itself out that way. I mean, it's already happened a little bit. Maybe nobody knows where the best jurisdictions are, just like some vague theories for now, but let's see what you guys think about that.
Yeah, I mean, I think cooperation is obviously ideal. I think that it's probably unlikely. I think competition is where things are going right now and probably where it's going to shake out, unless Joyce has her way. Which is to say that you may end up getting some sort of collusion through that metric, regardless if the United States or the UK or various countries in the EU develop a meaningful system and of regulation that they think is meaningful. Other jurisdictions may follow suit. It's possible that that might happen, and then you'll have various jurisdictions employing the same system, which people might not like. So I think that's a possibility. I think that there are jurisdictions out there like Malta, I think Switzerland as well, that have come out and tried to pass helpful regulation. I think that everybody's sort of waiting for the US and the EU and China to make meaningful moves here before anything really happens in this space. So it's a matter of time until that happens. But I think the big capital countries right now are still stuck and haven't made moves yet that would be helpful, I think.
Yeah, I think it's also challenging because generally speaking, regulatory bodies, at least the ones that exist, both in the United States and abroad, they generally don't regulate technology. They regulate conduct or the way in which you use that technology. And so I think there are certainly some jurisdictions that are trying to make themselves more attractive for certain uses of the technology. Like maybe they want to have more ICOs, or they want to have more exchanges, or they want to have a very security token friendly environment. But I think it really depends on the nature of the technology. My hope is that in the same way that we think of the internet and the way we use the internet in a kind of open source fashion, but nonetheless, anyone who builds a business on the internet or is supplying some kind of service using the internet, they have to comply with whatever rules and regulations apply. And all the intermediaries and businesses that are built on top of foundational technologies, depending on what jurisdiction they're in, depending on what the activities are, they'll have to comply with the rules and regulations applicable to them. And I think that's a better way to approach this technology, because I think blockchain networks are also foundational. They work best when open source, when everybody can rely on a shared standard. I think that's why the Brooklyn project and the open source approach is so important. If you're talking about things that benefit from network effects and benefit from uniform adoption, open source versions of those are generally speaking going to beat out proprietary ones. And so I think that's pretty crucial. And then, the hope is that regulators that are regulating the use of this technology in the different industries that they're responsible for regulating take, I think a thoughtful approach to how that regulation should apply. Obviously, if you're talking about using blockchain to represent real assets, things like custody are very important. Things like transfer are very important. If you're using it in some other use case, just as a representation of data or to share information, maybe it's a decentralized protocol, then restrictions on transfer are a real inhibitor. If you can't freely transfer a token, then it makes it difficult to operate in kind of the traditional conventional blockchain network structure. And so I think kind of it makes it, I think it's easy to talk about more like transnational solutions or some kind of proposed framework that everyone can adopt. But I think a lot of us enter the space because we have a healthy skepticism for the idea of some central authority being able to issue some kind of top-down approach. And so one of the reasons why I'm so excited about the Brooklyn project and the way in which they approach things is it's very much bottom up. It's asking market players to contribute feedback along with all the other stakeholders. And it may be a longer process. Maybe it would be easier if there was one person that could just dictate how things could be done. But it may not be as, I think, scalable long term, or at least as sustainable.
All right, I think that's it for us. Thanks for coming.
Thank you.